You know that feeling when you check your portfolio and it's down 3% in a month? Yeah, that's happening right now. The S&P 500 is down 2.9%. The Nasdaq is down 3.1%. And Bitcoin just took an 18.9% hit this month alone. Most people are panicking, pulling their money out, or just freezing entirely, which is exactly when Wall Street makes their best moves. Today, I'm breaking down the 5 investment strategies that the institutional guys are executing right now while retail investors are sleeping. These aren't complicated theories or predictions. These are things you can actually do this week to position yourself where the smart money is already going. Let's jump in. First, understand the context. We're in a market correction driven by AI jitters. Chip stocks are tumbling. The tech sector is getting hammered. The Federal Reserve is expected to hold rates steady in July and then hike again in September. That's the battlefield right now. And the big money isn't panicking, they're repositioning. So let's see where they're actually putting their cash. Move number 1, the quiet rotation away from mega-cap tech stocks. Here's what you're seeing right now. The Dow Jones is actually up 2.1% this month, while the Nasdaq is getting destroyed. That's not a coincidence. That's institutional money rotating out of the high-flying AI stocks and into old-school stable companies. Companies like Johnson & Johnson, Procter & Gamble, industrial stocks, the kinds of companies your grandpa would have owned. Why is this happening? Because valuations got insane. Everyone and their cousin was pouring money into AI plays, assuming every tech company would turn into the next OpenAI. The reality is, most of them won't. So smart money is saying, let's take profits here and move into companies with actual cash flow and dividends. When your stock is up 80% in 18 months and everyone and their dog is talking about it, that's when institutional traders start asking, is this actually worth this much? The answer is usually no. The move you can make right now. If you've been loading up on growth tech stocks, consider trimming those positions and reallocating some of that capital into dividend-paying blue chips. You don't need to sell everything. But if you're sitting on a 200% gain in a hot AI stock, taking 50% off the table and moving it into something like a dividend-focused ETF is exactly what Wall Street is doing right now. Move number 2, buying the boring index fund dip. This is where most people mess up. When the market is down, they sell. Wall Street does the opposite. They buy. The S&P 500 is down right now. So what are the big players doing? They're adding to their core index fund positions. Vanguard, BlackRock, Fidelity, they're all quietly accumulating shares in low-cost index funds like VOO, VTI, and SPY because they know something that most retail investors forget. Market corrections happen. They happen about every 18 months on average, and every single time, the market recovers and goes higher. So when the market drops 3%, institutional money sees that as a gift. They're buying more shares at a lower price. The people who get rich don't time the market perfectly. They just keep buying when it's down and holding when it's up. Here's the specific move. If you have an emergency fund sitting in a regular savings account making next to nothing, or if you have cash you are planning to invest, right now is the exact moment to deploy it. Put money into a low-cost S&P 500 index fund, a total market fund, or even a 3-fund portfolio like Vanguard recommends. The market's on sale, and I guarantee you that in 5 years, you'll be grateful you bought this dip. Move number 3, the AI hedging strategy that nobody talks about. Here's where it gets interesting. Wall Street isn't abandoning AI completely. That would be stupid. But they're smart about it. They're diversifying their AI bets across different sectors and companies, and they're specifically hedging against the ones that are overvalued. One major move right now is investing in the companies that benefit from AI infrastructure, regardless of whether any specific AI company succeeds or fails. Think about it this way. During the gold rush, the companies that made the most money weren't the ones panning for gold. They were the ones selling shovels and picks to the miners. Right now, that means companies like NVIDIA make money, whether your favorite AI company succeeds or not. Because every company building AI needs their chips. But here's the hedge. Instead of going all in on mega-cap semiconductor stocks that are already up hundreds of percent, institutional money is also buying companies in the AI infrastructure supply chain that haven't gotten bid up yet. They're also buying put options and other hedging instruments to protect their long positions. If you're not sophisticated enough to trade options yet, here's the simpler version of this strategy. Diversify your tech exposure. Don't put all your chips into the 5 companies everyone's talking about. Instead, use a tech-focused ETF that holds 50 or 100 companies. You get the AI upside without the single company risk. QQ is one option, but there are more specialized AI ETFs now that give you broader exposure. Move number 4, going all in on dividend aristocrats. Dividend aristocrats are companies that have increased their dividend for at least 25 consecutive years. These are companies like Coca-Cola, McDonald's, Walmart, and 3M. They're boring, they're stable, and they're paying dividends of 2 to 3% right now, which is actually meaningful when inflation is moving sideways and interest rates are staying elevated. Why is Wall Street buying these now? Because the math is simple. You're getting 3% from the dividend. The long-term stock appreciation on these companies is historically around 7 to 10% annually. So you're looking at 10 to 13% total returns without much volatility. Compare that to trying to pick the next hot tech stock and watching it swing 40% in a month. The guaranteed income stream beats the lottery ticket every single time for people building actual wealth. The Federal Reserve is expected to hold rates steady in July and then potentially hike again in September. That means bonds aren't going to blow you away either. So dividend stocks are getting more attractive. You can buy these individually, or you can use a dividend aristocrat ETF like NOBL or SDY that holds a basket of them. Move number 5, the green economy play that's actually working. Okay, this one surprised me when I dug into the data. Gold is down 8.5% this month. That's your traditional safe haven asset getting crushed. But you know what institutional money is buying instead? Green economy and renewable energy stocks. Why? Because the fundamentals are actually improving. We're in 2026 now, and renewable energy is finally becoming the cheaper option in most markets. The LSEG report on investing in the green economy for 2026 shows that institutional money is moving into this space, not because they're being noble or environmentally conscious, but because the returns are starting to actually work. Solar, wind, battery technology, electric vehicle infrastructure. These aren't government subsidy dependent anymore. They're becoming economically rational investments. Now, this sector is still volatile. So the move here isn't to go all in on individual green companies. Instead, look at diversified green economy ETFs or funds that spread the risk across the entire sector. ICLN or CLEAN are 2 common options. You're betting on the trend, not on any single company getting it right. But here's the biggest risk nobody's talking about, and I need to be blunt about this because it matters. The market is pricing in some pretty optimistic expectations right now, even after this month's correction. If the Fed's September rate hike turns into multiple hikes, if economic growth slows faster than expected, or if we get some kind of unexpected external shock, we could see a real correction, not just a 3% dip. I'm talking 15, 20, even 30%. The professionals are positioning for that too. They're keeping cash reserves. They're taking profits on outsized gains. They're building positions in uncorrelated assets. The move isn't to be fearful. The move is to be thoughtful. Don't go all in on any single strategy. Balance aggression with defense. Keep some dry powder. And understand that even if we do get a bigger correction, you're better off in the game than out of it, especially if you're young and have decades to recover. So here's your action plan for this week. Step 1. Audit your current portfolio. Look at your biggest positions. Are they up 200, 300%? Take some profits. Move that money into something more stable. Step 2. If you have cash, start deploying it. The market's on sale. Don't wait for it to be even cheaper because you'll miss the recovery. Step 3. Look at your dividend exposure. Make sure at least 30 to 40% of your portfolio is in stable dividend-paying stocks, or dividend ETFs. Step 4. Diversify within sectors. If you like tech, don't own 5 mega-cap tech stocks. Own a tech ETF instead. And Step 5. Check your emotional response. Are you panicking? That's a sign you're taking too much risk. Are you completely unmoved? That might mean you're not taking enough risk. The best portfolio is the one that lets you sleep at night while still making progress toward your goals. This is what separates the people who build wealth from the people who talk about it. When the market is down, they buy. When everyone else is panicking, they stay rational. When volatility is high, they see opportunity. That's not luck. That's discipline. And it's a discipline you can start practicing today. If this video changed how you're thinking about your investments right now, drop a comment below telling me which of these 5 moves you're actually going to implement this week. Are you going to rotate out of tech? Are you going to buy the dip? Are you going to hedge your AI exposure? Let me know. And if you haven't subscribed to Money Mindset TV yet, now's a great time because we're dropping market breakdowns like this every single week, sometimes multiple times a week, when the markets are moving like they are right now. Subscribe, hit the notification bell, and I'll see you in the next one.